Yo, right. This is cover calls. I always notice what people are pushing on the internet, especially YouTube, and there's a covered call frenzy, like ETFs that are covered call based strategies, YouTube finance gurus that are just pushing this covered call strategy as if it's some holy grail. And I do not like covered calls, and I want to explain why. Let's go. All right, so what is a covered call and why might you do it? We'll go with the basic, not the basic, the, well, let's just go for it. Okay, you got 100 shares in Microsoft, and you've heard about this covered call thing. So what it is, you get up the options chain for Microsoft, and you go 45 days out, you go a week out, at some point out, and you find the call side, and you line up your call to sell, and you'll make something like 50 cents for every 100 times 100. All right, so you bought your 100 shares, and you want to try this covered call thing because it's the holy grail. So you find a call that's a few strikes higher than where the stock is trading, and you sell one call for every 100 shares. Okay, first problem for me, 100 shares. So if a big stock, take Microsoft, you're not going to own 100 shares. Take Netflix, it's $1,000 stock. You're not going to own 100 shares. So you're already limited as to the universe of stocks you can sell a covered call on, because you want, for every 100 shares, you want exactly one options contract. Because if you have to take this to expiry of the option, they need to match off. That's problem number one. Problem number two, you can see the payoff here. So you've sold your call at 105 in this example, and let's say the stock jumps, it opens up at 110. You've then got this big loss on the call, and you've only made a certain amount from the stock. And if you've got a long term, what I found when I was selling calls against stock, because I've tried this, is that you end up with this call, and you actually want to hold your stock position. So, but you need to close them both at the same time. It's a one-off, one-on, one-off trading setup. If you take off the call and then the stock drops, you've made way less than if you just bought the stock. So I hate it for that reason. Next thing is, if you do take it to expiry and the call option is exercised, you lose your stock position. You have to buy in again. So for me, it is only, the covered call trade is only there if, say, I would potentially take it if I think a stock is going to go down and I'm long the stock, but it happens to go up and you hit expiry, and then the call is exercised and you lose your shares and you come out of the position. For me, it's almost a bearish or a static stock expectation position. You actually, for me, it's not a trade you put on in a bullish environment, or if you think the stock is going to go up, because you really get trapped as the stock goes up to your strike price. You start losing money on the call, and then because you've got to take it all off, you can't hold your stock position. Or you take it through expiry and you lose the trade. So for me, it's really I'm putting a cap on this stock. I will be happy if it stays where it is or goes down. If it goes up, I definitely want to be out of the trade. That for me is the covered call trade. And it's not sold as that. It's sold as you own Microsoft stock, you paid the dividend, Microsoft is going to go higher, and you're going to keep pulling in these cool, the premium that you sell. Really, the reality me and my ministers always discussing things like, we've started doing it a lot more. We're like, what's the reality of what we're either about to do, or like a holiday we're thinking of, or a like a training regime for the kids, or like today we were discussing getting a fitness coach. I'm like, when are the kids gonna have 2 hours when they're fully fit in a gym and able to follow the instructions of like a remote instructor by the phone? The reality of the situation and the reality of a covered call is that it is a really unsuitable trade or like setup. You can see on this profile, you've only got this tiny window between this break-even price of 95 and the price of 105. That's it. If the stock goes up past 105, which isn't a big gain, you've lost the upside. If the stock goes down past 95, you have no protection. Max loss is the stock going to zero. And when this goes down and you're rolling down your call to take in a little bit more premium, it really is peanut money. Calls are always priced really badly because they are not an insurance trade. Puts on the other hand, are an insurance trade, so they're normally priced a little bit richer. Calls are not priced richly, so you're often selling for literally peanuts. And so I also hate it for that reason, because they're not. This isn't a good payoff. You want limited downside, generous upside. I'm not going to say infinite upside, because that also doesn't work. But this is not a good trade. And I will go into more of the option strategies I do like. But the covered call, it really isn't all that the internet cracks it up to be. Here we go. So I've just searched in YouTube, covered calls. So covered calls explained. Covered calls, too good to be true. No, there's nothing, I mean, look, there's nothing too good to be true about them. Cheat codes for covered calls. No, there's no cheat code. Covered calls, see, look, this is more like it, guaranteed loss, yeah, because most of the time that's how calls work out. All this is someone trying to promote their covered call setup. And if you just try one, if you want to try one, if you've got 100 shares of Microsoft, you want to sell a call somewhere around the 25 delta on the call side, sell it and see what happens. If the price of Microsoft goes up to your strike, you'll be kicking yourself. If it goes down, you'll roll down the call, and at some point you literally get trapped like a rat. And then you lose your position and you wonder why you started this whole covered call thing. But basically, in the covered call, you are long the stock, and you'll get a tiny payoff for selling the call. That's it. And that's if you're lucky. That's if you're incredibly lucky and the stock sits between, where was that chart? And the stock sits between your break even and your strike price. It really is. You're onto a hiding to nothing. And so what's my point? Well, my point is, don't trade the covered call. Trade the short put or the short put spread every time. All right, that's it.